I want to talk about how costs flow through the financial statements. That's actually important from an accounting perspective. And what we have here are 3 blue boxes. And these 3 blue boxes at the top, labeled raw materials, work in process, and finished goods, are inventory. And they're really inventory accounts on the balance sheet, but they correspond perfectly with inventory locations in an organization. The raw materials, you can think of that as a warehouse. And wherever you receive your product, whatever materials you receive, wherever you store those, that's the raw materials inventory account, and it's the warehouse. When we issue direct materials to production, those tires, engines, the paint for the painting machines, that direct material flows then out of the raw materials and into work in process. Work in process, or WIP, is the production floor. All production that is currently taking place happens in WIP. Any inventory that has been started and not yet completed resides in the account called WIP. Once we complete the manufacturing process, the value of the completed inventory shifts out of WIP and into finished goods. And that COGM says cost of goods manufactured is the technical term for that. And now we have it in finished goods awaiting the revenue recognition when the matching principle would have us recognize the cost. Once the revenue recognition happens, we shift those costs out of finished goods inventory and down to the green circle, which is on the income statement as cost of goods sold, or COGS. But direct material is not the only flow of inventory. The second and third are both here. Direct labor, you can see the circle on the top. So again, I have a laser pointer, so on the top up there. That direct labor also gets added to WIP. We track everybody's labor hours and we add those to the value of inventory, because in theory, those people working, the direct employees, are transforming that product and adding value. So that goes into WIP. And then somehow we have to take all of this overhead, and because it's non-traceable, it has to be applied or spread like a peanut butter across all the cars that we're making, and it has to be allocated into WIP as well. So we have material, labor, and overhead all in WIP combining to create a finished product that then moves through the financial statements. Note in this slide, the green overhead circle is a green circle also because in this case that resides on the income statement, and it's a sub-account within COGS. And some people like to think of it as the manufacturing overhead control account. At the end of the day, it's really honestly, it's an overhead variance account, but that you don't have to know necessarily what that is. Raw materials also contains indirect materials, safety equipment, repair parts, spare parts for your machinery and equipment. And so those, imagine that you need hair nets to run a shift in paint. And so somebody goes over to get some hair nets from the warehouse. You have to fill out some kind of a material requisition, probably online. Then there'll be somebody over there, or maybe they even bring them to you. There's a Kanban location. However your company does it doesn't really matter. The point is, at that point, the hair nets leave the raw materials inventory and go into overhead. Now, if there are any hardcore accountants in the room, you probably already just straight up expensed hair nets when they arrived because it was immaterial cost and it's just easier to expense it. And if you get what I just said there, I'm just pointing out you're right, and that's a good way to think about it, and you recognize that I'm not, I do see that that's the better way to do this, but in the idea of teaching the class, think of it as every material that arrives from Grainger goes into the warehouse and it gets issued to the production floor, one way or the other, as direct materials or as indirect materials. And if it's direct materials, when it gets issued into the production floor, it slides over into WIP. Indirect materials goes down to overhead. We add to those indirect materials, indirect labor. So things like maintenance workers, HR people, the accountant that Mehdi saw that none of the rest of us saw, those people that are all in the factory that are doing indirect work, as well as the other overhead. So that's like the rent, the depreciation, property taxes, all those costs associated with production that are neither material nor labor. At the very end of this process, we have this thing called the sweep entry. And what that means is we are going to apply in some fashion, I just point with a laser pointer, we're going to apply in some fashion this overhead up into WIP, and we're going to take all the actual overhead that arrives and put that into overhead. And, oh, thank you, Hillary. And so the overhead that are the actuals and the overhead that gets allocated out might not exactly match, because the overhead that gets allocated out is going to be based on a budget. And the overhead that actually happens is going to be based on reality. So that overhead account might end up with some number other than zero in it at the end of the month. If that happens, we have to expense that, because we have to take that whether it's let me rephrase that. We take that amount to expense. It may be favorable or unfavorable depending on if you actually spent more or less than you budgeted, but you take that to expense. If you spent less than you planned, it should drive your cost of goods sold down because you actually saved some money. If you spent more than you planned, it'll drive cost of goods up because you actually didn't account for enough when you planned your overhead allocation or application or absorption, whichever word you prefer there. Okay, how do we do the application then? To apply overhead, what we need to be able to do is come up with a rate, an activity rate. The activity rate can be called a PMOH, a POR, a POHR, it's all the same. Predetermined manufacturing overhead rate. Predetermined overhead rate. Predetermined overhead rate. They're all the same thing, okay? How we calculate that is we take your estimated overhead for the usually year, but it could be the period. So that's usually your budgeted overhead. We divide it by some estimate of your activity that you're going to use to assign these costs into inventory. In other words, I need something that can be traced to help me to allocate or spread these costs back into inventory. And that activity that can be traced that I'm going to use is called an activity driver. And so to calculate my rate, I need to divide the budgeted overhead by the estimated amount of that activity for the coming year. Then, as actual production takes place, we take that rate and multiply it by the amount of activity that we observed and add that amount of overhead into WIP to account for the fact that there's actual value being added because there's a building to do the construction in, or because there's a forklift driver or whatever else. I would ask, but I am a little behind and I want to save the time for other stuff here. So I would ask what else your company uses as activity drivers, but I want to save that time for Q&A on the back end. I want to walk you through a little bit here about a bottled water. If we were trying to cost bottled water, how would that look for us? And so what we have here in the top left up here, we have the direct materials. The bill of materials says there's a bottle at 5 cents, 12 ounces of water at 1 cent per ounce, a label that costs 8 cents, and in total the materials are 25 cents. Then there's direct labor that is 0.001 hours of labor per bottle at $12 per hour. And we project that this year we will sell 100,000 units. That 100,000 units matters because we're going to need to do the allocation that we were talking about. And so we get into into the year and we start making bottles. All those direct materials get issued out of the raw materials or the warehouse. They go into work in process. It's 100,000 units, 25 cents per unit, $25,000 material cost. People work. How much do they work? Well, we said it takes 0.001 hours per bottle on 100,000 bottles is 100 hours. At $12 an hour is $1,200. You can follow the red dot. This is helpful, hopefully. Okay, that gives us direct labor and direct materials are now in WIP. The overhead one is the one that we have to do next, and that's the one that's the tricky one. So how do we come up with that predetermined overhead rate? The first thing we do is take the estimated overhead for the year. Let's say we budgeted $15,000. Then we take the amount of direct labor hours we estimated for the year, 100. We divide one by the other to get a rate. Our rate then is 15,000 divided by 100 is $150 per direct labor hour. Now, we observe that we worked 100 hours of direct labor. That's this $100. This 150 is the rate from above, the line above. Multiply them by each other, and this says we thought we were going to spend $15,000. This breaks it into a rate and an amount in case we were wrong on either part, or we create a different variance. But in this case, the assumption I'm making, if you're looking at this to make it simple, is that we actually worked exactly what we planned, and that $15,000 then ends up going straight into work in process. Now, it's worth telling you here, I know I didn't teach you a lot about debits and credits, but one of the things that I could have told you about debits and credits is in this diagram, the arrowhead is the debit end of every transaction, and the non-arrowhead is the credit end of every transaction. So when you issue materials out of the warehouse and into WIP, you debit WIP and you credit the warehouse or the raw materials, okay? That's how the flow goes. So the cost of the overhead application, the debit goes into WIP for $15,000 and the credit comes back into this overhead account. Now when we get the actual overhead spend as it begins to accumulate throughout the year, $2,500 of indirect materials, $4,000 of indirect labor, $4,700 of other overhead, totals up to be $11,250 of actual overhead. Oh my goodness, we actually put $3,750 too much overhead into the inventory account. We have overstated the value of our inventory. We've made an error. What do? At the end of the period, the $15,000 is a credit and the $11,250 is a debit. They'll net out to each other and we'll be left with $3,750. And that's where the sweep entry comes into play. The sweep entry will then move that over into COGS, and we ended up with $41,200 worth of cost coming out of finished goods, but then the true-up adjustment at the end of the period was $3,750, leaving the net amount on our cost of goods sold to be $37,450. Let's test and make sure that this worked. Did we actually account for all of our costs? All of our costs included at the bottom: direct material of $25,000, $1,200 of direct labor, $2,500 of indirect material, $4,000 of indirect labor, $4,750 of other overhead, total $37,450. What hit the income statement? $37,450. It works, okay? You might say, why go through the overhead application process and then true it up against the actuals? The answer is, I don't know the actuals in advance. They change. I can make an estimate and I put that into the inventory account, but I don't necessarily know what I will spend in workers' compensation claims until the end of the year. I can make a best guess, and then I fix what that guess was on the back end. So that's why we split this into two different stages like this. So this moves all of our costs into cost of goods sold on the income statement, as it should. And if we spent $37,450 to make 100,000 bottles, we actually spent 37.45 cents per bottle to produce water. We now have a good idea of what our cost is for bottled water. Would that it could be that all of our products weren't as easy to cost as a bottle of water, right? The Mustang, for example, has about used to have 3,000 parts in the bill of materials, that alone. Hundreds, actually thousands of operations. And so it becomes very difficult to cost. But nonetheless, it would be the same process. It would just be with a lot more information.